Hello and welcome to our October market update. My name is Doug Johnson. I'm the senior investment strategist here at HCM Wealth Advisors, and I am joined, as usual, by my colleague Dan Rinck, who is also an investment strategist here at the firm and a member of our investment committee. Dan, how are we feeling today?
Uh, Pretty good. Inflation came in a little softer today. Markets are looking good, so I'm in a good mood.
Yeah, we're gonna touch on all that today. So I think one of the underlying themes of this presentation, and I don't know if we actually put a title on it, but kind of this square peg in a round hole idea, and I think that can go a few different ways. But I think one, there's just a lot of underlying things taking place in the market right now that are a little bit unusual, not necessarily bad, but certainly unusual. And then, also this idea that I think a lot of investors want to trade the market they want instead of the market they have. And we read a lot of stuff here, and I've noticed that kind of the pickup in this concept that I call anchoring to extremes is starting to pick up again, where everything either has to be the end of the world, 2000 or 2008 again, or the market's going to 8,000, and the AI is going to change the world. So I think the truth probably lies somewhere in between there, and we're gonna touch on some of that stuff today. But I've noticed a pickup in that type of mindset here just recently. So we touched on the idea of some underlying oddities in the market. So Dan, I'll let you go ahead and start there.
Yeah. There's been a lot of themes and narratives and stories this year that have come and gone, but yeah. So it's been a very interesting year. We have equity returns and low double digits at this point in the S&P 500. Everything seems to be rallying. Um, Under the surface, you're really seeing that there's a lot of risk appetite, and you're seeing a lot of investors reaching in some really interesting areas. So this chart is the factor performance for the last 12 months through September 2024. Factors being, qualifications on types of stocks. Um, and it basically shows the recent 12 months versus the last 20 years of normal performance. The last 20 years is the circle dot there, and then the recent 12-month performance is the bar. Um, and you can see it's a sliding scale. Everything on the left is doing well. Everything on the right is underperforming kind of the base benchmark. Um, but if you look at this chart and squint at it, you're like, okay, that's probably a normal market year. Some things are going to do well, some things are not. But if you really drill down into the factors that are showing the outperformance, it really gets interesting, right? So on the far left, the equities that are performing the best are stocks that have performed the best previously. So you see a lot of momentum. So anything that's been going up, people are plowing into it and making it go up more. High beta names, those are your riskier names, the stocks that move um, much more than the overall benchmark does. Um, you're seeing very low quality on the left side and high potential growth names. And on the right side here, you're seeing all the things that normally you would see as attractive when you're owning a company. You're seeing high dividend yield. You're seeing attractive enterprise value to sales. You're seeing low earnings dispersions. You're seeing attractive price to sales. So you're seeing solid, strong companies that have very strong fundamentals on the far right, and they're underperforming the overall market. Um, so it's a little bit backwards. When we see this type of action, it shows that investors are really reaching for risk. And that's been a story that has pretty much prevailed throughout the whole entire year. Um, And then drilling down a little bit further into that, for really just the S&P 500 and the Nasdaq, kind of the big large cap space, uh, this is, a very interesting chart. So these are the average year-to-date performance of the companies in each kind of category. Now, again, they're all positive, so it's been a year where it's been positive equity returns across the board. But if you look at the far left, the average price return for the Nasdaq companies that have no revenue is 34%. Mag 7 at 18. Now, these are, your largest tech companies that are very strong and they make a lot of money, but valuations can be a little stretched at time. They're at 18.
It surprises me that you can even have a company listed on Nasdaq that doesn't have revenue.
I I agree.
But
I agree.
that's a topic for
That's a
another day.
different topic. Yeah. Unprofitable NASDAQ. So companies that have revenues, but they're still not making money because their expenses are too much larger. 18. Now, what's really interesting is when you get further down to the right here, unprofitable or profitable small and mid caps are up 5% on the year. And then if you go to unprofitable US small and mid caps, they're up 12%. So again, it's a very interesting space where you are seeing some of these traditionally shunned names that don't have any revenues or aren't making any money from a profit basis, really, really showing a lot of investor interest. Um, yeah, and then this is kind of the quality factor. So the quality factor is basically strong fundamentals, good balance sheet, um, and what
Everything on the right side of that chart that we
everything on
saw
the right side of the
two
chart there.
slides.
So this basically shows quality stocks versus the S&P 500. And in this chart right here, when the line is going up, that means high quality names are outperforming. When the line is going down, that means high quality stocks are outperforming or underperforming. Um, so currently, right now, we're in a very deep drawdown for high quality names. This is not uncommon. You see the line kind of ebbs and flows back and forth as investors get risky and then they want to go back to quality and then get risky and back to quality. Um, the extreme we're at right now is pretty significant. I mean, that minus 10.4% performance goes all the way back to kind of the run up of the tech bubble. Um, so, when you're looking at it, if you have been buying high quality company names and strong value names that don't follow one of these narratives that have really been driving the market lately, you've probably underperformed the broad market. Now, you've been positive, you've made money this year, but you've definitely underperformed some of the more um, headline grabbing themes. And again, this is not oh, well, quality is going to underperform forever. This will eventually snap back. We don't know when, we don't know to what magnitude, but currently it's an environment where it pays to own kind of the, I don't know, wild themes. I don't even know how to describe it. And then same thing in the small cap. So small cap is even more interesting because you have a large mix of companies. Um, It's not as high quality as US large cap. A lot of the Russell 2000, which is kind of the 2000 stocks in the small cap index, a lot of them don't make really any money on a profit basis. But this chart here shows the S&P 5 or not the S&P 500, the S&P 600, which is a small cap quality index versus the Russell 2000, which is kind of all small caps. So the Russell or the S&P 600, the companies have to be profitable. That's one of the metrics or one of the requirements to be included in the index. Um, this chart here, year to date, shows that the Russell 2000, which doesn't have any real requirements, it can have anything in there, is up 14% year to date. And the S&P 600, which requires the company to meet these standards of profitability, is only up 4% year to date. So it just really shows you that investors are kind of reaching, trying to get in on these high growth, high potential theme names so far this year as as they're really really risk on. And then breadth. So we talk about breadth quite a bit. You know, if you're looking at where the market is right now, we're at all-time highs today. The S&P 500 just broken all-time highs. You have Nasdaq performing very well. I mean, we're in low to mid double digits in pretty much every single index. Um, if we're looking at the percentage of stocks that are overbought, so high RSIs, companies that have really ran kind of outside of their normal fundamentals, it's only at 21%. So that's not a high number. That's not a number that gives us any kind of alarm. And the percentage of stocks that are oversold, so they are, have been kind of pressed down and almost capitulatory trading, it's at 43. So from a breadth perspective, we're not really seeing anything that is flashing warning signs. Um, we obviously these numbers change quickly as the market moves, so we track these pretty closely. But from a breadth perspective, even after us, you know, especially with the inflation report this morning running to all-time highs, there's not any real red flags here that is telling us that we need to be super worried about some kind of bubble in any
Yeah,
way.
you wouldn't necessarily see this in a market that we would call euphoric.
No, and I mean, again, there's corners of the market that th this chart looks very different.
We're gonna touch on one of those.
We're going to touch on that, but if you're looking at the broad S&P 500, you're not seeing many alarm bells going off from a breadth perspective. And then what is driving the markets overall? So earnings here. You're having some reacceleration of earnings. Um, earnings numbers are pretty strong. They're low double digits. They haven't really been revised down some, and they're even starting to get revised up. So from an earnings perspective, we are in a pretty good spot. The 2025 is that yellow bar there. And again, it's starting to pick up. There was a lot of uncertainty around tariffs, around the Fed, all that, and we're starting to get little bit more clarity, and companies are, not really being as reserved and, not cutting spending or doing anything crazy on their end because they're starting to see a little bit of a clear picture. So these earnings estimates are picking back up, and that's really what you need for a sustained market rally. Um, and then US companies so far this year have been beating earnings. So I think it's about 85% of earnings calls this year have been beats. So, we have these positive low double digit earnings growth numbers, and the companies are coming in and still beating them. So, from an earnings perspective, if this continues, if tariffs um, really don't stall out kind of the corporate picture and earnings remain strong, I mean the baseline fundamentals of the stock market are in a pretty good spot. And then yeah, so if you were a active manager, fund manager that has a process, again, Doug was mentioning earlier about people making their story and trying to get people to believe what they're seeing in the market is reality. Um, it's been a tough year for active managers. Active managers often have, strong screens for, quality earnings, quality profitability, and it's been one of the worst years for active stock pickers in recent memory. I mean, we're looking at 2014, 2008, 2009, the tech bubble were really the only other times in which there's been active returns as bad as this. It's been really tough for some active managers. We love to index here at HCM, so we like owning the broad market because we we know it's very difficult to beat the broad market because of times like this. But again, I mean, you're looking at active managers who do this for a living and are looking at it every single day, saying, "Here's my, bread and butter factors," and they're kind of um, getting beat down a little bit. Now, again, this
Yeah,
this does reverse. we're at 20, it can go up to 60, like, but again, it's been an interesting year.
Yeah, I mean, I think the challenge for not only active managers but everyone who's trying to manage money right now is you can see what's going on. You can see the factors that are being rewarded. Momentum being one of those, and then the ones that are I don't know. I don't know that we call them being punished, but maybe not being rewarded, so to speak. And I, you can't you can't take all of your clients' money and put it into the most aggressive stuff. It's just not it's not feasible. But that for whatever reason this year has been the way to go ahead and do that. So as we look at some non-stock items, one of those being tariffs, which is everyone's favorite topic. The China U.S. tariff conversation was put back in the news recently as President Trump talked a little bit about maybe not meeting with President Xi over the next week or so. But when you're talking about China and the U.S. in terms of tariffs, I think this chart here lays a lot of the issue out, and it's really going to be over rare earth, both production and reserve. And you can see here that China represents roughly 68% of the global production of rare earth materials. And then they have 38% of the global reserve. There's not a country on here that's very close to that. I mean, the US is second, but they're at 12% and 2% respectively. So I think this kind of dance back and forth with the tariffs, with China specifically, has to do with this kind of rare earth mining production and reserve. And that's going to be the main focus. And, we've said this before, and I'll say it again. I think that both sides stand to lose enough here where they will eventually make a deal, whether that's next week during a meeting, whether there's going to be some more tweets or headlines or whatever. We don't know that, but I think over the long term, or even the intermediate term, so to speak, we would expect that ultimately a deal will be reached in terms of the tariff conversation. So, from an economic standpoint, GDP estimates are, still in a pretty good range. This is the Atlanta GDP Now kind of real-time estimate for Q3, right at about 2.5%. I mean, and if you look at, or I'm sorry, the Atlanta Fed estimate is now up to almost 4%. The range from the top 10 and bottom 10 forecasts are about 3.5 to, we'll call it 1.5. So still a positive number, and you can see that this has been trending up. So for all the talk about tariffs, a weak job market, anything else that you want to come up with, the economy on a GDP basis seems to be trending in the right direction. Now, we just had an inflation report come out this morning. It was kind of right on the nose, so to speak. But if we look at this chart going back to 2018, we can see obviously the big increase during 2022. And then this black line, which is really the 12-month change. I think that's probably the more appropriate line here with less noise. I mean, you've got the 3-month annualized and then the 6-month annualized. And as you compress the time frame, you're going to get more kind of jagged peaks and valleys here. But this 12-month change continues to trend in the downward direction. Now it's right around 3%, which, as a reminder, the Fed target is 2%, but I don't think the Fed is going to feel a lot of pressure if that CPI is right around 3%. I think they're willing to give some room here in order to make sure that the labor market remains strong. But in terms of overall inflation, things seem to be, I don't want to say they're going away completely because there are, I think some pockets that are showing higher than others, and there has been some questions about the calculation of CPI itself, but from a market perspective, the report today was a positive. And then how have rates trended since this whole kind of tariff thing started back in April? Well, one of the concerns was that tariffs were going to be ultimately be inflationary. But the bond market is kind of saying something else. You've had the 10-year go from, we'll call it 4.5-ish, down below 4%. 4% had been a level that had been hard to break. I think we tested it, 3 or 4 times this year, or over the past 12 months. And this is the first time we've been able to sustain anything underneath it. Same with the 2-year. You've got it going from right around 4%, we'll call it, to 3.5. And then you have the 5-year kind of market inflation expectation rate, which is sitting right about 2.25, we'll call it. So, the bond market is basically saying, hey, we're not necessarily concerned about inflation at the moment. And I think that, as we talk about these themes of, trading the market you want and not the one you have, I mean, bonds, I think, are a perfect example. After 2022, you had a lot of people shunning bonds completely, saying they didn't want to own them anymore. And then you had, tariff conversations and the worry that we're going to get inflation reaccelerating and all this stuff that I don't know. The timeline makes sense, but I guess the data is just not there yet. And, the Barclays Ag, which is basically the S&P 500 for bonds, is up almost 7% this year. So, it's just another one of those areas where the data's kind of saying something that the narrative might not be. Now, we talked about bubbles earlier, and everybody's talking about AI. They should be paying attention to gold. So this is a gold chart going back to 2018. You can see that this move is pretty extreme. We would call this almost parabolic. And there's a saying in markets that parabolic moves don't resolve themselves by going sideways, meaning that you're not going to see it go up and then just kind of go like this. All right. The resolution has to be a downward movement at some point. And earlier this week, we got one of the largest one-day moves, excuse me, on a percentage basis for gold in quite a long time. And from that, you got, this kind of spider web of selling in some of the other areas that had been also extremely hot, we'll call them. So quantum space, nuclear names, like some of the stuff that had just run up quite a bit. And even with this move, I don't think the change for gold, or the story long term for gold, has changed. I mean, we added a small amount of gold back in, I think it was June, based on the idea around, uncertainty with, the fiscal situation in the U.S., the debt situation, and how that's going to be impacted long term. But when you see moves like this, it doesn't matter what the asset class is. You're now getting speculators and leverage traders in here, and that needs to be resolved at some point. So I think that's part of what we saw in the gold move. Now, you hear us use the phrase RSI sometimes. It basically just stands for relative strength. How strongly is something trending? So this is gold on a 14-week basis. All right. So this is a weekly measure going back to 1985. All right. We just basically saw one of the highest, if not the highest, RSIs on a weekly basis for gold, almost touching 90. That is really, really overbought. Now, what has happened historically when we've seen this exceed 80? The average return going forward has been pretty muted. So there's nothing in this chart that would suggest that gold has to go to 2000 or that's just going to crash. I mean, I feel like crash is the buzzword nowadays in the market. Like, it's like nothing can just go down. It has to crash, so to speak. It doesn't have to do that. And we can see here that historically, like the returns haven't been great, but they also are not down significantly. So, if you're a long-term holder of gold, I don't think that you have anything to worry about quite yet. But if you've kind of jumped on the gold bandwagon and tried to catch this move, you might get a little bit of indigestion going forward. Now, when we talk about markets kind of anchoring to extremes, I've heard a lot of comparisons between this market and the tech bubble. And I think some of it is probably valid. Some of it I think is extremely lazy. It's just tech stocks are going up now. They went up then. These two markets must be the same. But I just want to highlight a few things that are different this time. So, this shows the S&P 500 technology sector, both from a profitability and evaluation standpoint, and comparing it to, I guess, what was the peak of the tech bubble back then to what we have now. So the return on equity on a trailing 12-month period in March 2000 was 20.5. So that's a pretty good number. It's not bad. Now the profitability number is 32.1%. So you have a higher ratio of probability. And I think this is probably one that I think is more important. So what the valuations were over the 12 months. So we've heard a lot about valuations being above average, which I think is completely accurate. And you could say that on a historical basis, we're kind of in that upper range, so to speak. What I will say is valuation has never been and never will be a good timing tool. It speaks more to the returns over longer periods of time, but I think a lot of people want to use it as a trading vehicle. At any rate, tech sector right now, 30.4 times. That's pretty high. Back in March, it was 51, right? So almost twice as much in terms of valuation. So, when we talk about 99, 2000, I don't think the amount of froth is there quite yet. I think there's a bigger layer of profitability across the board here. And if you do think it's like 2000, this next chart is probably going to, really blow your mind. So if we wanted to run an accurate analog of what this is versus the dot-com bubble, this is what it looks like. So the current path from a starting point of, we'll call it 100, is at 128, right? So if it was going to match the exact price movements of the dot-com bubble, you're going to get it up to close to 400. So that's another 2 to 3 times higher than where we are now. I think people forget how crazy 2000 was. Not only on the way up, but the way down. You had, I want to say it was 4 rallies in that downturn that were 35% or more. And it happened over a period of like 18 months. So, I think the comparisons that we're seeing right now to the tech bubble are more anecdotal than anything. But if we look at the data, I just don't think it matches up quite yet. And then, you're hearing a lot of talk about, tops and crashes and all of this. Usually that happens from euphoric markets. And when we look at sentiment specifically, like this is not a euphoric market at all. Maybe some spots, but
Everyone hates this market.
it's really like one of the most hated bull markets ever. So here's the fear and greed index. We're at extreme fear right now. And then if you look, at the AAII sentiment survey, which we looked at a little bit, like overbought and oversold, the amount of bearish investors right now is higher than the amount of bullish investors. The spread's right around 0, but then the 8-week moving average, you've got more bearish investors than you do bullish investors. You usually don't see that at the top. So I think everyone's just, it's like, what do they say? A watch pot never boils, or doesn't boil as fast as you want. It's like, if everyone's standing around waiting for a crash, so to speak, it's likely not going to happen. And then, when we look at what sectors of the market have been leaders here. So this is a chart that shows what's called the SHUT index. So SHUT stands for staples, healthcare, utilities, and telecom. It's basically the more defensive sectors of the market against the S&P 500. So when this orange line is going up, that means defensive sectors are outperforming the overall market. Usually happens in down markets or right before we start to see a topping process. Going the other way, you've got more risk involved. This has been a one-way street since, we'll call it 2008, right? You've had the market outperforming these defensive sectors, and we've had little kind of increases in this where the defensive sectors have outperformed, but it's not been anything sustainable by any stretch of the imagination. Now, the flip side of this, you could say, wow, this has gotten to an extreme measure. Maybe I should start putting some money into those indexes because they're really undervalued versus the overall market. But again, people are not really enamored with kind of boring returns in a market like this, but it's certainly something to watch. And then, are we seeing any stress in credit spreads? You had some headlines specifically about things like private credit. There was a fairly big default that had some ripple effect. But if you look at both the corporate index and the high yield index from a credit spread perspective, you're in the 9th percentile for high yield and the 5th percentile for corporates. That is not stress by any stretch of the imagination. If you want some comparisons to, again, these extreme markets that everyone loves to point to, back during the tech burst, high yield spreads got as high as, we'll call it 11.5. They're at 3.5 right now. During 2008, you had them going as high as 20%. Corporate spreads, you had it at almost 7%, which is twice as high as what you're getting in high yield right now. So the bond market is usually a pretty good indicator of significant stress. And again, we're just not seeing it in the data. So the last chart that we'll look at talks about future returns. And we just had that kind of big down day where gold was down a lot. It kind of metastasized itself through the market. And you had a VIX jump that was to a pretty high level. But here is the history of when the S&P 500 is within 3% of an all-time high, which is where we were, and you have VIX jumping over 28, which is usually a sign of fear in the market. And if you look at this chart, now not again, this doesn't guarantee anything, but the track record of this is pretty good. You have 100% success of a positive market over 2, 3, 6, 9 months, and then 1 year later with some pretty outsized returns from those numbers. So I guess the takeaway here is that even with a big volatility spike close to all-time highs, that has historically been a good thing for markets going forward. So as always, if you have questions, comments, concerns, please feel free to reach out to your advisor, to myself, to Dan. We want to be a resource. We want to be there to answer any questions that you might have and make sure that you are allocated the way you want and that your interests are being represented in your portfolio allocation. So again, we thank you for joining us, and we will talk soon.